Hello everyone, my name is Jitin Kaur. I am talking about topic risk analysis in capital budgeting. So, what is a risk? Risk can be defined as the potential of that chosen action or activity will lead to a loss that called a risk. And what are the types of risk in a capital budgeting? First is a market risk. A market risk, also known as a systematic risk or non-diversifiable risk. Market risks affecting the overall economy or financial markets, interest rates, inflation rates, exchange rates, and overall market volatility. A second risk is a business risk or company specific risk. This type of risk also known as a unsystematic risk or diversifiable, means we can diversify the risk by eliminating, and this type of risk pertains to a specific company or industry which can be which in the investments is made. An example include changes in management, company, industry, in which and also a technological obsolescence and supply chain disturbance. Third is a financial risk. Financial risk refers to uncertainty associated with the company, and fourth is a regulatory and a legal risk. Regulatory and legal risk, changes in a law, regulation, government policy that can impact the business environment. This type of risk include new regulation, compliance cost, and other changes in taxation and other legal aspects. And fifth is a operational risk. Operational risk arises from the day-to-day operation from the businesses. uh, Example equipment failure, supply chain disturbance, and human errors and natural disasters. Sixth is environmental and social risk. Environmental and social risk relates to impact the company operation on the environment as well as relationship with the stakeholder, including customers, employees, communities, and society. And last risk is a political or country risk. Political risk, like uncertainty in the political instability, government policy, geopolitical tension, and other socio-economic factor that are specific to each country. And these are the risk in a capital budgeting, like project specific risk, industry specific risk, competition risk, company specific risk. These are the risk. Uh, in a risk, we are techniques to evaluate the risk in a capital budgeting. Mainly focus on the this type of the risk, like a certainty equivalent approach, risk adjusted discount rate, standard deviation sensitivity analysis, and break-even analysis, and other techniques are evaluated in a risk in a capital budgeting. First is a certainty equivalent approach. Certainty equivalent approach is a ratio of assured cash flow to uncertain certain cash flow. Under this approach, cash flow flow expected in a project are converted to a riskless equivalent amount. So the adjustment factor is also called a certainty equivalent approach. This varies between 0 and 1, and coefficient of 1 indicates that project of the project of that cash flow are certain. The greater the risk in cash flow, a smaller will certainty equivalent uh, factor. By employing this method, the decision maker estimate the he must be assured of their receiving in order to his indifferent between an assured sum or expected value of a risky sum. These are the case. uh, we can uh, evaluate basis of this. And second techniques for evaluating risk in capital budgeting is a risk adjusted discount rate. The required rate of return on any investment should include compensation of delaying consumption equal to risk free rate return plus compensation of any kind of risk taken on. uh, Risk associated with any project is higher than risk involved in any kind of project. Discount rate is adjusted upward in order to compensate the additional risk borne. Risk adjusted discount rate is a sum of risk free rate and some risk premium. Risk premium depends on perception of risk of investor of particular investments and risk aversion of the investments. These are the formula for the evaluating risk adjusted discount rate. Uh, in the risk-free rate, what is a risk-free rate? It is the rate of return of the investment that bear no risk, like government security, yield a return of 6% and bear no risk. In such cases, 6% is a risk-free rate, and risk premium is the rate of return over and above the risk-free rate expected by the investor as a reward for bearing extra risk. For higher risk project, the higher risk premium will high, and lower risk project risk premium would be lower. And third is this is a difference between risk adjusted discount rate and certainty equivalent. uh, Risk adjusted discount method recognize the uh, yield of the same result certainty equivalent approach. If the risk free rate is a constant, risk the certainty equivalent method recognizes risk in a capital budgeting by adjusting estimated cash flow and employ a risk-free rate to discounted trusted cash flow. On the other hand, a risk-adjusted discount rate adjusts for risk by adding some extra risk premium to risk-free rate of return and arriving the discount rate. And third is a sensitivity analysis. Sensitivity analysis is a modeling techniques that is used in a capital budgeting decision to study the impact of changes in variables on the outcomes of the project. In a project, several variables like weighted average cost of capital, consumer demands, price of the product, cost price per unit that impact the outcome of the project. In the sensitivity analysis, a project outcome is studied after taking into change in one variable. The more sensitivity is the NPV, the more critical is that variable. So sensitivity analysis is a way of finding impact of project or internal rate of return for a given change in one of the variables. There are following three steps involved in a user sensitivity analysis. First is the identification of all variables which has influence on the project NPV. NPV means net present value or IRR, internal rate of return. Second step is establish the relationship between these variables. And third is analyze the impact of changes in each of the variable on the project NPV or IRR. The decision maker, while conducting sensitivity analysis, computes the project NPV IRR for each forecast under three assumptions with the probability of their occurrence pessimistic, expected, and optimistic. These are the case for analyzing the sensitivity analysis. And fourth is a scenario analysis. Scenario analysis is the process of forecasting the expected value of performance indicator given a time period, occurrence of different situation, and related changes in the value of system parameters under uncertain environment. This analysis begins with the base case or most likely set of value for the input variable, then go for the worst case scenario, low unit sales, low sales price like high variable cost and so on, and best case scenario. These are the case, so we can evaluate the risk in a capital investing. And fifth is a Hillier model. That uh, Hillier model is a computation of the standard deviation of several ranges of cash flow that enables a firm to determine the uh, uncertainty involved in the future projects. The more certain is a project, is lesser would be deviation from the various cash flow from the mean cash flow. Under this model, there are two cases of analysis. First is when there is a no correlation among the cash flow, and second step or case is when there is a perfect correlation among the cash flow. And sixth is a simulation analysis. It's also called a Monte Carlo. Monte Carlo simulation is a computerized mathematical techniques that allows decision makers to calculate risk and uncertainty in the decision making. This analysis it generate a range of possible outcomes and there are probability associated with the outcomes. And this analysis start with carrying out the simulation exercise to model these investment projects, and it involves identifying the key factors that affect the projects and their relationship, and this technique is widely used in the field of project management, stock return analysis, and etc. Simulation analysis is run several times to calculate net present value, specific parameter value kept constant throughout the simulation, whereas the viability of the project is determined on the basis of the number of outcomes and probability realized through a series of actions performed during the simulation analysis. uh, for managing risk in a capital budgeting, uh, there are the various things we can need to analyze: fixed and variable cost like pricing strategies, sequential investment, improving information, long-term arrangement, strategic alliance, derivatives, shorter time to market, contingency planning is, and the